Welcome to the Silk Lectures featuring Nobel Laureates. My name is Ludwig Chincarini. Our guest today will not be giving a talk. Rather, we will interview him on a variety of topics. As always, I want to thank Jeff Silk, Naomi Silk, and the Silk family for making this series possible. Eugene Fama is a giant in the field of finance and economics. His biggest contributions are probably his definition of efficient markets and the explicit acknowledgement that any test of market efficiency also is a test of the model being used. The Fama-Macbeth techniques to test markets and his testing of the CAPM theory, which led to the well-known fama-french factors that are used as a basis to test market efficiency and market strategies all over the world. He was awarded the Nobel Prize in Economic Sciences in 2013, along with Robert Schiller and Lars Hansen. Gene is the Robert R. McCormick Distinguished Service Professor of Finance at the University of Chicago. Gene, thank you for doing this.
You're welcome. My pleasure.
You've been an inspiration to me and so many other people. We're going to talk about everything today, from your life to your academics, to your research, and I hope you enjoy the interview.
Okay.
So let's start with general issues. What is the biggest lesson that you have learned in your career about economics?
I guess I never thought of that question, actually. But I think I would answer it that whatever you do, it's probably the case that somebody else hasn't done it completely the way you're doing it. So don't spend a lot of time doing background reading. Do what you want to do, and then look at the background reading and see if it works out. As for specific ideas, that's a good one. I don't know. I guess in my view, the biggest idea, and I'm biased, the biggest idea is the option pricing model that Black, Scholes, and Merton developed in the early 70s, which was a problem that Paul Samuelson had worked on for years and had never cracked. And they solved it, and they got a Nobel Prize out of it. And that is a theoretical model that's taught to all people in finance, everybody getting a PhD in economics, and it's used widely in practice. In economics, it's difficult to find something that does all of those things.
What were you doing when this happened? Where were you when the Black Scholes was discovered?
I was a professor at Chicago. Myron had left at that? No. Yeah, Myron was not there anymore, I don't think. But I was a professor at Chicago, so they submitted it to the JPE, and the JPE refused it. So Merton Miller and I went and said, "Did you know that this thing has been a problem that people haven't been able to crack for a long time?" And so on our positive review of the paper, they accepted it.
Oh, wow.
So it's probably the most cited paper they've ever had in there.
Yeah. And what do you think the biggest economic issue today is?
The biggest economic issue today.
And what should we do about it also?
I don't know what the biggest economic issue is. I think there are lots of big political issues, but not big economic issues. I think it's a mixed economic political issue. I think people's expectations of what the government can do for them are too high. Mm-hmm. And that probably won't end well, but we'll see.
Any other ones that come to mind?
In the sense of?
Big issues. You said big political issues. You mentioned one.
Well, that one's pretty big. I kind of worry that our politicians are going the route of making people expect things that they won't themselves pay for. Mm-hmm. And I remember way back when I was a student, there was a famous law professor at Chicago who said one of the biggest problems of a democracy is curbing the ability of the poor to steal from the rich. Mm-hmm. That's putting it kind of crudely, but I mean that's the basic problem. I don't know whether it's not a problem in the sense that it has to be kind of kept in mind by people. Mm-hmm. But unfortunately, there are people in politics who actually feed it. They don't try to get around it. So I have this rule that says whenever a politician puts in a tax hike of some sort, that politician has to pay it, and if it says it's got a progressive rates in it, the politician has to pay at the highest possible rate for as long as that rule is in force, regardless of what his own income or wealth level
That's an
may
interesting.
be.
That's an interesting proposition.
So that he internalizes
the decision.
Right, the decision, right.
Okay, great. What do you think of the stock market right now? Are you bullish or are you bearish?
Well, the way I always answer that one is I don't look at the stock market until a few years later. I don't
Okay.
look at the current data. I never make a prediction. As you probably know, I made my fame on the proposition that you can't predict it. So
yeah.
I still adhere to that.
Regarding your efficient markets, do you today? We're going to get to that later
Right.
in the thing. But do you today believe that you had these three forms of market efficiency?
Right.
Do you think even the strongest form is also adhered to? Although it's hard to test, I guess.
Not really. I mean, if you look at professional investment managers, they've been tested inside and out, and it holds up pretty well. It doesn't hold up for insiders. Insiders clearly have information that outsiders don't have. So to that extent, that version of the model is false. There are also periodic episodes that are clearly violations of market efficiency. Cases where, like, this GameStop thing went out of control. Finance is like any other thing in economics. It's all supply and demand. If the demand gets really high out of line, you're going to get prices to get out of line. The question is that the exception or the rule? I think it's the exception, not the rule. And I would say people should hold diversified portfolios to protect themselves against things like that.
So you were speaking earlier about people expecting too much. What do you think of the current stimulus package? It's a very big package,
right.
and in general, what the government's been doing.
Well, I have nothing against the government extending unemployment benefits, or even making payments to poor people. But I think this is kind of the first 100 days you get to do things that you're not going to be able to do thereafter. And this looks kind of like a grab bag. You throw everything in it, and if you really went down to the nitty-gritties of it, I doubt that anything approaching maybe probably a quarter of it actually has to do with the people suffering from the pandemic. The rest of it is things they want to do anyway. So,
Okay, good point.
well, I think that what goes unsaid in this is you hear a lot about interest rates being low and that making it cheap. Well, the problem is the principal doesn't go away because interest rates are low. It has to be repaid no matter what. That's the real kicker in all this. So this is another problem, I would say, that nobody ever talks about, is that, okay, we have a democracy, everybody votes, right? But the future generation doesn't vote. And they're the ones that are going to pay for all of this.
That's a good point.
Pay for all of this stuff. So they're not weighing in on this yet. They're not even born, maybe, lots of them, but they will get to pay for it.
That's a good point. Going back to stock markets, you know that recently value stocks have been hurt last
Right.
2-3 years, and so
Other than that, actually, but
okay. And so what's your thought about value versus growth in the future, and what's been going on? Any thoughts on that?
well, yeah, we actually, Ken French and I just published a paper on that. Basically, you can't tell. It's been a much longer period than 2 or 3 years, but these so-called premiums are high volatility things, so you can't really tell even with 20 years of data whether the premium has changed or not. And that's basically the position we're in at the moment, is that these premiums have been low, and people are wondering whether they've gone away. Well, the problem is statistically you can't tell because the volatility is too high, and that's about where we stand. So if you do a regression of value returns on their book-to-market ratios, what you'll find is the expected returns are probably lower, but you can't say how much lower. There's too much uncertainty associated with that.
So you would need at least, 50 years?
50 years would start getting you in the ballpark, right?
Right, okay. The last stock market question. What do you think about owning American stocks today versus international stocks? Do you have any thoughts?
Well, yeah, I do, actually. This is stuff I've been teaching for a long time. So when you look at the international data, what people don't typically take into account is there have been many periods in time when international investors get expropriated by the foreigners because of war, or even not war. They just suddenly say something that more or less expropriates to some extent the foreign investors. That doesn't appear in the data. You get the data; it's always just live markets. So it's you don't see that part of the return. Now, if you actually look across the world, the U.S. market portfolio has about the same volatility as a global portfolio. So you don't get overall a big diversification effect from investing internationally. But they are a little not so highly correlated. But the problem is the foreign industries have much more volatility. So the gain you get in diversification basically gets absorbed by the fact that they're more volatile to begin with.
I see what you mean. Yeah.
So when you put them together, they have about the same volatility as the U.S. market.
And has it gotten worse because there's so much international trade, so many conglomerates? Has that made this problem become bigger, or not?
I haven't looked at the data for maybe 10 years, so. But the process was over. So what's happened is markets have gotten more correlated through time as trade has become more important. But it was still the case when Ken French and I wrote this paper that was like the early 2000s, that the volatility of the overall combined world market portfolio was about the same as the U.S. portfolio. And that's not including emerging markets.
Okay, great. We're going to move to your contributions to finance and investing now. Could you describe your early career and what made you decide to study economics?
Okay. This is a long story. I'm not sure you want to hear the whole thing. So I was an undergraduate at Tufts, and I was majoring in Romance languages, and I thought I was going to become a sports coach and a high school teacher teaching Romance languages. And I was getting really bored with that. My third year, I took an economics course, and it turned out I was pretty good at it. The professor was reading my exams to the class, and I went to work for him. His name was Harry Ernst at the time. Turns out I learned after the fact that he was a great golfer too, so you'll appreciate that. But he hired me to work on he had a stock market forecasting firm. And he hired me to develop schemes to beat the market. And every time, but I did it, came up with a scheme that worked in the data that he gave me to work with. But he had always kept an out-of-sample hunk of data, never worked out of sample. So that was a lesson that eventually I wrote my thesis on. So.
Wow, that's a great story.
But anyway, when it came time for me to decide, I was more interested in economics than doing this stuff. And I thought I'd get a graduate degree. All my professors were former Harvard PhDs. And I said, well, I want to go to a business school. And they said, well, don't go to Harvard Business School. If you really want to get a PhD, go to Chicago, because they have more of a research orientation there than Harvard Business School. So I applied to the Harvard Business School. I applied to University of Chicago Business School. And along comes March, and I hadn't heard anything. So I called up, and the dean of students answered. This was in the days when schools was very small, so the dean of students actually had a telephone. But he answered the phone, and we chatted for a while, and he said, well, I take to say this, but we have no record of your application. And he said, but what kind of grades do you have? And I said, well, pretty much all A's. He said, well, we happen to have a scholarship for somebody from Tufts. Do you want it? And that's how I ended up at Chicago.
That is a great story. And how did you know even to think to go to business school versus something else? How would you even know?
I didn't, frankly. I thought that becoming a business school professor was a way for me to pursue my athletic career without too much interference. You know, being a
tennis
college teacher. I wasn't really into tennis at that point, but as it turns out, it was a happy experience, though. But when I got there, when I got to Chicago, I went to talk to the guy who was the professor who was the director of the PhD program. And he said, well, we're not going to let you in right away because I want you to learn that graduate school is a lot different from undergraduate school. And I went back to him at the end of the quarter and I said, boy, were you right. Graduate school is a lot different from undergraduate school. It's a lot easier. Because the quality of the students in the business school at that time was way below the quality of the students at Tufts. So
wow.
The competition was nowhere near. But they were excellent PhD students, but the MBA program was not that strong at that point.
Well,
that was at the time when the Ford Foundation plowed a lot of money into MBA programs to improve them.
So you did an MBA and then?
No, I switched almost right away. And at that time, you could do both.
Okay.
So you got an MBA and a PhD. But I finished my PhD in 2.5 years. It wasn't.
Well, and who was your favorite professor? Do you remember?
Sure, that's easy. I'm Merton Miller and Harry Roberts. So Harry Roberts was a statistician you probably haven't heard much of. Merton Miller, I'm sure you've heard of.
Yeah.
So those two, when I was writing my thesis, I would meet them in the faculty lounge every time I had some new output to show it to them. And they were always very patient with me. So I kind of remembered that when I get impatient with my own students, how much time they spent with me. So.
And what were you, in those days, what were you programming in? What were you?
Oh my goodness, that's such a great question. So I would go over to the computation center, which was, the machine would fill this room. And there was me and a professor from the physics department. I would go in the middle of the night there because during the day you couldn't get near the place. You couldn't get your stuff to run. I'd go in the middle of the night and this physics professor and I would use the machine. And we would call IBM and say, you know, this compiler that you're using, it's got this problem. And they would laugh and say, no, what do you know about that? And after about 4 times that they checked it out, they said they started listening because every time it was a problem. But that's how it all started. And I remember you had to allocate. There was 1,000 memory locations, and you had to allocate them within the program to the. I don't even know how we did that.
That's a lot of work. Would you say back then? So today, we're going off script here, but today, anyone, my computer probably can do 1,000, even more than what you could do back then. Back then was the, I don't know how to ask this question. Now anyone can do a regression. Back then, very few people. Was part of the key that because it was so difficult, only the people who really learned it and tried to do it would excel? Or what was the...
No, in those days you had these punch machines that you would put stuff into, and every professor had 2 research assistants doing the same thing to see if they got the same answer.
Oh, wow, yeah.
And computers, of course, killed that. But it was, you know, it's become much easier to do empirical work because of computers. But the computer, wristwatch is more powerful, 1,000 times more powerful than the computers of those days.
That's crazy, yeah. So early in your career, you worked on the definition of market efficiency, and other people have studied it as well, including Cowles. What inspired you to study market efficiency? What gave you that spark to go look at that?
Well, I didn't invent that line of work. As you say, the other people were interested in it. And we were married already. We already had 2 kids that we had to feed. I wanted to get done quickly. And Merton and Harry Roberts were very interested in this line of work. And they weren't into computers yet, so they were always amazed that I could do stuff that would take, that they thought, weeks. So I got interested in it because I could get people's attention. And it turned out to be very profitable because, you know, basically everybody was kind of feeling their way towards what an efficient market really, what it meant to say the market was efficient. But nobody really had the nuts and bolts of it down. The nuts and bolts being, you really can't test market efficiency without a model that says, well, what do you think the price formation should be? So that's basically a model of risk and return, a pricing model. So you have to have that. So it's what I would call the joint hypothesis problem. And then testing. You can't test market efficiency without a model of market equilibrium. And every model of market equilibrium basically assumes that markets are efficient. So those two are like the Siamese twins of...
The fama-french model is one of the most well-known factor models in the world. What prompted you and Kenneth French to go after that? What was the inspiration that led you to the fama-french?
Well, we did a paper. So I was one of the first people that did a paper testing the capital asset pricing model, Bill Sharp's capital asset pricing model, which says that market beta is the only thing you need to describe expected returns. And that model I had written a paper with Jim Macbeth, one of my PhD students, saying that model worked pretty well from like 1926 to maybe the 40s or 50s. But then when French and I updated it to the 60s and 70s, it just wasn't working at all. So we basically wrote a paper that said the CAPM is dead. It's just hasn't worked for a long time. The relation between beta and average return is flat. So we need something else in asset pricing. And there had been work already that said that if you sorted stocks on their book-to-market ratio, which is a measure of value, the higher book-to-market ratios tend to have higher returns, and smaller stocks tend to have higher returns. So we basically, with a little bit of economic intuition, introduced a model that would accommodate those two factors, along with the market portfolio. The market portfolio is a part of every asset pricing model. So that was the so-called three-factor model that we came up with. I thought it would be a total failure, because when we wrote the original paper, what we had done was to say, well, here are the things that people have discovered that are related to average returns. We didn't discover any of them ourselves, but and each person has said this is a violation of the CAPM, but nobody had put them together and said, well, there's so many of them that model's just not working. And that did it. So when we put them together, I said, this paper won't even get published. And it turns out to be like the second or third most cited paper.
It's amazing. So what do you think, why did it become so popular? What happened? Why? You thought it was going to fail, and yet everyone uses it, everyone quotes it.
Well, not the model. I was convinced the model would work, would catch on. I wasn't convinced that the original paper that said the CAPM was dead was going to be as big as it turned out to be. Okay. But once people accepted that the CAPM wasn't working, then they were wide open for the three-factor model that we developed based on the evidence from the JF paper.
Okay, so now I've got a criticism. So some people have said that the fama-french has misguided finance for 30 years. I did not say this. Some people saw. And I remember when I was in graduate school, I worked for Fisher Black at Goldman for a little bit. And I remember the first meeting with him. I didn't know what he meant, and I had to go read it. But I was in his office, and I said something like, why don't we check that paper by Eugene Fama? And he said, no, we're not going to do that. That's data mining. And so...
well, Fisher had this... I knew Fisher quite well. He was at Chicago for a couple of years, and I knew him before that, long before that. But basically, he was one of the developers of the CAPM, so there was nothing that was going to tell him that didn't work. So that was the data dredging as far as he was concerned. That anything except that was data dredging. Fisher could be very, he'd get an idea, he would not give it up no matter what. No amount of data was going to convince him otherwise. So that doesn't bother me.
I was going to ask you again, why did the fama-french get so many citations, and why did it become so famous? But you're not sure either.
Well,
I mean, in other words, why?
That's a question I can't answer in general. Okay. So if I were to look back over the 128 papers that I've written and said, which ones of those that I predicted in advance was going to be a big hit, I would not know. I'd be terrible. None of them. Be terrible at it.
Well, while we're there, what do you think your best paper was, independent of what people reacted? If you have to pick what you thought was the best paper.
Now?
Yeah.
Well, they're highly widely cited, but they're not what I'm primarily known for. But in the early 80s, I did a lot of agency theory that people, that's very highly quoted, very highly cited now. And those are papers that I chuckle about because most people think of me as an empirical guy, which I am primarily. But there are these 3 or 4 papers there that get tons of citations that are pure theory, my kind of theory, soft, so not a lot of equations, but just simple verbal theory, the kind I was taught when I went to graduate school. So I think put those together, and they're pretty good. Put the fama-french stuff together. I think it's pretty good. The whole bundle package of stuff there is pretty good. The two, the factor paper and the one that gave rise to it, they're pretty good.
So we're still on fama-french, and so the fama-french model started with 3 factors.
Right.
And now it's got 5, I think, 5 or 6.
Right.
And so my question is that a sign that it's not working?
It's a model. Remember, we use that word model because it's not reality. It's an approximation, and it's going to have problems. And the original 3-factor model had problems, and we threw in these 2 other factors because they were suggested by really simple kinds of economic theory about this stuff. But I'm not happy about that because I've become kind of negative on factor models because it just kind of opened a Pandora's box of things that people would look at and try to not necessarily develop models, but develop investment products that they wanted to sell. Based on these
That's
things.
right. Well,
Right.
we're going to get to that too, because
Right,
one of
right.
your students did that as well.
Right. So I'm kind of, I think asset pricing at this point is kind of in limbo in the sense that none of the models we have, including the capital asset pricing model, the consumption-based model that Lucas and Breeden developed, which is really a tour de force of on the intellectual scale. I mean, that's the basis of all asset pricing, but it's never worked. It's never worked well, that one. And so I think we're kind of in a period where, if you look now at the people doing asset pricing, none of them are looking at the fundamental stuff like that. They're looking at the stuff around the fringes. So it's kind of a quiet period as far as new paradigms in asset pricing are concerned.
Okay, thank you. There's a lot of questions on this, on these factors. I might start to sound boring, but I'm going to ask you this one too. So I remember the first time I did small minus big, or right. And the first thing, now I did it I don't know what date it was, but I did it, and I remember one of the things that made me sad, and by the way, you can correct, maybe I misinterpreted, but was that the effect was really small. And I don't know if it was the period I looked at, and I was a little bit sad. And today, when you did your work with French the first time, if you looked at small cap stocks, their P ratios were relatively low. Today, if you look at small caps versus large caps, probably these smalls have a higher P than when you did the study.
I don't know.
Would that change your opinion? In other words, I guess what I'm asking is there still a small cap effect?
Well, see, if you go back to the original small cap stuff that Bonds and Rangingham did in the early 80s, it turns out that they were using New York Stock Exchange stocks.
Okay.
And on the New York Stock Exchange, the small cap premium, it's still there over a very long period of time. But a lot of it does come from small value.
So is that another thing people should watch out for? What the universe you use is important.
Right.
Okay. So,
Sure. I mean, absolutely important. It's absolutely important.
And you and Kenneth French today, is your size still based on NYSE, or you've expanded?
Oh wait, no, sorry. When we define the size, we use NYSE stocks because you've got thousands of NASDAQ stocks that don't have much market cap, so they don't amount to very much. So if you're looking at proportions of market cap, basically that puts you onto NYSE stocks. So we still use the median NYSE market cap to define size.
Okay, on to something new, because we've talked a lot about the factors. How do you think the access to detailed quantitative information has changed the way that you would look at your model or any model? The fact that, for example, now people are downloading data from Twitter and all these other things.
I don't. This is a question I get every time I do something like this. And the fact is, you can't tell from the data what effect better access to information, or quicker access to information. You can't tell what effect that's had on the price formation process. People have speculated and tried to find instances where they could identify effects, and I don't know of a single one that's actually succeeded. So I don't know the answer to that question. I don't think there is one yet.
Okay, thank you. This is a silly little question, but do you believe markets are weak form efficient today? Well, actually, all forms. Do you believe they're weak form efficient, semi-strong, and strong? What's your view on each one of those, based on all your?
Yeah. Okay. So if you go to the weak form, I don't use these terms anymore, but if you go to the weak form, there's this thing called momentum.
Okay.
That's been in the data historically. That's been a problem because so if you follow stocks that have gone up for the last year, they tend to go up, keep going up for another couple of months. And they go down, they keep going down for another couple of months. That's in the historical data. It hasn't been there for the last few years, but that's an embarrassment, I think, because either their risk has changed a lot or the market's inefficient. And if their risk has changed a lot, it happens so quickly and it changes so quickly, you don't have a prayer of measuring it. So that was a big embarrassment, I think, for the weak form market efficiency. Semi-strong form, I don't know of any big embarrassments there. Strong form works really well, except for insiders.
Okay.
Strong form looks terrific. Bill Schaap has this, what he calls the arithmetic of active management. And it's really a theorem. It says that passive investors in aggregate hold the market portfolio. What that implies is that active investors in aggregate have to hold the market portfolio. So they can't do better than the market in aggregate. But if you look at them after costs, it means they have to do worse than the market after costs. So that's kind of the downside of active management. Now, French and I spent a long time, and other people have done it too, trying to figure out, well, okay, can you sift among the... So what it implies is that there are good active managers and there are bad active managers. This is a proposition, not something you would like to test. Can you identify the good ones or the bad ones? And we tried to do that. So the problem is, if you're actually an active investor, you hold an undiversified portfolio. Otherwise, you're not active. You're faking it. So when you the problem then is you're going to get a wide distribution of outcomes because they're not holding diversified portfolios. So what you want to test is whether the cross-section of returns that you observe for active managers deviates from the cross-section you'd expect by chance, given the characteristics of these funds. And when we did that, I can't go into all the details, but there's a published paper in the JF. When we did it, what we found was, if you look at them before costs, there is evidence that there are too much in the extreme tails. So there are good guys and there are bad guys before costs. After costs, very difficult to identify the good guys. It's all getting absorbed in their fees and expenses.
Wow.
So.
Okay. And then you mentioned momentum being an embarrassment. Wasn't the person who first wrote about that, was he a student of yours?
Yeah.
Yeah.
Cliff Asness, right.
Yeah. Oh, it wasn't Mark. I thought it was Carhart, or both, maybe.
Oh, sorry, Carhart. Oh, sorry, it was Mark, sorry. Right.
Mark.
Yeah, Carhart, right.
Yeah, and so were you his
Right.
advisor?
Right.
So it was embarrassment, but you also helped him do it in a way.
Well, I mean,
Yeah.
I've never thought I had a vested interest in this.
Right.
In this stuff. I mean, everything's wrong.
Yeah.
To some extent.
Right.
That's
Right.
if we really knew what was right and what was wrong,
Yeah.
the world would have folded up a long time ago in economics. Everybody would know everything at this point, but they don't. So I've always been open to the idea that you got to be ready to accept stuff when it's a contradiction. Otherwise, you're in the wrong game. So you can't have a personal vested interest in the outcomes. But I've had colleagues that did not follow that rule, and as a consequence, I think their work suffered from it. But it never bothers me when something like that comes along. I remember Cliff had it, Asnes had it in his thesis. He had a big thing on momentum, and he said he was afraid to show it to me. And I said, why? I don't care whether if it's there, it's there. You have to publish it.
Right. And now he's making money off it.
Yeah, well, he's trying to, right?
So David Booth was also, I believe, one of your students.
Right.
And David Booth went on to start the amazing firm Dimensional Fund Advisors that has, I don't know how many billions under it.
560.
560 billion. And can you describe your relationship with David Booth, how you might have inspired him, and then how it all happened?
Well, he like Cliff and other people before him, every year I would take the best PhD student and make him my research assistant the following year. So I always got the first year PhD students in the asset pricing sequence. And David was the best of his year, and he became my research assistant the next year. And after 2 years, he came to me and said, I see what you do, I don't want to do it. so I called Mac McCorn and I got him a job at Wells Fargo, but he didn't last there very long. He went to work for some other firm, and then he came back, I don't know whether it was 10, 15 years later, after he had a lot of experience, and said, I want to start a money management company and I want you to be involved in it if you are willing to. And I said, fine. I said, a lot of my students have started money management companies, but nobody ever invited me to participate in it, even though they got it from my classes. So I've been involved with them ever since.
That's great. And he's also been so successful that he's given so much money to
Right,
Chicago.
that's why it's called the Booth School.
Yeah, it's amazing. A great relationship. And even Kenneth French, I guess, is there at DFA. And
well, he works with them. He and I work with them together.
wow, okay. Well, excellent. And speaking more about DFA, what was your role at DFA? What has been your role?
I was part of the original group that formed the company. My role was basically as a consultant. What David said, and Rex Sinkfield was in there in those years too. They said, you just do what you do. We don't care what you do, and we'll figure out if there's anything in it that we can use. We don't want you to do anything that would affect. We don't want you to change your research because we think what you do is just naturally good for developing products out of it, and that's the way it's always been. So that's basically what I do, and help them maintain the products in the sense of if anything new comes along, or if there's something to look at that maybe we didn't look at, to get their people to work on it. So they have, I think, at this point, probably 20 PhDs on there. They have as big a finance faculty as we have in the business school.
Back to the factors. So I know you, and correct me if I'm wrong. I believe you don't like behavioral explanations for factors. So my question is, for the value factor, momentum factor, and size factor, why do you think they work? Well,
just the cash flow equation tells you that they could possibly be involved in a rational asset pricing model. So that's my view of it. If you want to put in a behavioral explanation, then my problem with that is, okay, that's fine. I can't really, based on the data, I can't tell the difference because all I'm doing is looking at returns.
Right.
But if it's a behavioral explanation, I expect it to go away.
Right.
So, if I say to the world, this is a behavioral explanation, this is a profit opportunity, it has nothing to do with risk, then I expect it to go away. So.
Well, but I don't know about all the factors, but some of the factors, there have been studies that showed after the paper's been published, it diminished and things of that sort.
Right. That's a big problem in academic research because people fiddle with the data. I mean, they do lots of tests and then they report the strongest results.
I see. So you think there's also a little bit of, no pun intended, data mining going on with testing this stuff.
Absolutely.
Yeah. How do you stop that? I mean, we're off. This is again strained, but that's one thing I've always known. So, like you, I first went. Well, unlike you, I went to the private sector first, And I did a lot of models. And what I learned, like you did for your professor at Tufts, is a lot of the models just didn't beat the market out of sample.
Right.
And so, but what I saw, at least in my career, is that every time you try to publish something that has no result, usually you get rejected, or there's a negative, it's not, people don't like to do it. So how do you solve that problem for academia?
I don't know, but I know what French and I have always done is, so when we did the original, the factor stuff, what we said was, okay, this is data from 1963 to 1990. Let's extend the data backward. We had to go collect the data by hand. Because the reason we started in 63 was that's when CompuStat started. So we said, okay, we'll just go and collect the data backward. And a PhD student actually did that and wrote his thesis on it at the University of Illinois. And the same effects were in the earlier data. So then we said, okay, now let's look at international data and see if you see the same thing. And it was there too. So we said, well, this looks pretty good. I mean, those are two robustness checks that you would do. Then out of sample afterward, it doesn't look as good. So whether that's a consequence of people jumping on these things, or it wasn't data dredging to begin with, though, because we looked at everything that was available.
Well, and I guess I was also asking, how do you, the fact that people don't like to publish negative studies.
Yeah, how do you get around that?
How do you get around that? Yeah, you were mentioning.
You can't.
You can't.
I don't. It's still true. People have been aware of this problem forever, and nothing has changed.
So we're still in the factor models, and the questions are going to get more exciting. But Bar Rosenberg, as you probably know, started BERA many years ago, and they started using factor model. One of the things they had is industry dummies, and today if you look at the leading software providers of portfolio management tools, they all have industry dummies.
Right.
And I spoke to you a long time ago and on the phone, and I asked you, why don't we have industry dummies in a fama-french factor model or something like that?
Right.
And you said, because you don't need them or something like that. And so my question is, why does the professional software use industry dummies, but you and others don't have them? How do we resolve this?
Well, I think the way to resolve it is simple. If you take the violations of the CAP-M, for example, don't come about from industry portfolios. If you put the industry portfolios through, like we did this. We looked at the industry portfolios in our three-factor model. Works fine. So, without the industry factors. So that's what I meant when I said you don't need them.
Okay.
Now you can, if they absorb variance, you can put them in there, even though they don't help you to explain expected returns. So there's nothing wrong with putting them in there,
Right.
as long as you're saying, okay, we're just trying to absorb some variance here, take out all the common stuff. But if you're saying I'm trying to explain the dimensions of expected returns, well, then you don't need them.
Okay, fair enough. You have said that you don't like the term bubbles, and correct me if I'm wrong, especially predicting bubbles. I agree with you that trading on a bubble is extremely difficult, and I've read some of your comments on that, so I agree with that. So, but the question I have is there some sense in which the bubble idea makes sense? And so what I mean by that is, you might not be able to trade on it, but you say to yourself, this market looks way overvalued, it's going to come down. Is there some way to think of a bubble in that light, or
No, that's the only light.
Okay.
That's the only light, is that you can predict the end of it. You can predict because it's gonna break. But if you're just after the fact looking at movements and prices and identifying, oh, that's a bubble, that's totally empty. I don't see. But
I see your point. Okay.
If you can do something predictable based on it, then that satisfies me.
But let me go back, actually, because I maybe didn't make my point clear. Okay. So suppose it's 2005.
Okay.
I'm going back. All the things you're looking at say the market is a bubble, okay? But if you ask me to trade on it next month, I'm going to be wrong, because it took a few more years, right? So how do you categorize?
Wait, that's a good example.
Okay.
Good. So there's a famous thing where, I forget who was the head of the Fed at that point.
Greenspan?
Greenspan, right. So Greenspan made a speech about the market being overheated.
Yeah.
And everybody points to that as being identification of a
Right.
bubble.
Right.
Well, if you actually look at the data, what happened after that is the market went up a lot more.
Yeah.
And when it did crash, it never got to the point where he made that speech. So he never did predict. It never did meet the criteria or prediction.
Right.
So, and then after it went down, it went up way past where the previous peak. So
Right.
What was the bubble? The up and the down, or the down and the up? You know.
Okay, I got your point.
It's got to be predictable.
Okay. And so let me move to another one, which is, again, I don't know if there's prediction. So
Yeah.
in terms of your definition, I don't think you predict it. But many people say Tesla, the stock Tesla, is overpriced. I think today it's worth more than all 10 of the largest auto companies in the world. It's trading about 221 times EBIT, okay? And so I don't know if I or anyone else can predict the turn,
Right.
but how do we classify that kind of stock?
It's a bet on the future, a strong bet on the future. Well, look, you're looking around the world and you're seeing all the governments coming online saying you have to make cars that are all electric, and they've got a big leg up on it. That doesn't say they'll keep that leg up
Right.
on it, but at the moment they have the biggest leg up on it. I mean, GM is currently saying that they're going to be all electric by when, 2035 or something like that. I would bet against that one, actually, because I don't think that company can turn around on a dime like that, whereas Musk seems to be able to do it. But we'll see. Remember now, it's very difficult to predict who will be the big winner. So remember back in the 2000s, the early 2000s, when all of these .com things were going crazy, and people said, "Well, they can't be worth it." Well, if you look at the winners of that time, the big winners, people didn't predict who the big winners would be, but their capitalization at this point is way beyond anything people would have expected.
Amazon, eBay.
Now,
Yeah.
well, eBay, I don't know what theirs is at this point, but you know, you got Amazon, Google, and all those things that came out of that basically. But you would not have been able to predict at that point, out of the thousands of startups, that these 5 were going to make it. So it's a difficult game to play. But as a whole, I don't think the market was overvalued at that point. They just didn't identify who the winners would be, but they knew there was something going to go on here.
Other than your own work, what do you think is the most important concepts or things that students of economics and finance should be aware of?
These big questions that you asked me, I've never been good at big questions, and I'm proving it today.
Or just what should they read other than your own work to do better in the future, to understand the future?
Well, in economics, you know, the basic blood and guts of price theory has been the same forever. But there's been an explosion of empirical work. What year did you go to school?
In MIT?
Yeah.
In 95.
Okay, so it was already on at that point. I mean, Gary Becker and all those guys had already started it. But if you go back to my time, there was no empirical work in microeconomics. And now that's a huge area that it just exploded. So what are the big ideas there? I don't know. The big ideas, I suppose, were Gary's big idea was, if you think of everything as an economic process, there's a lot of work that families, whatever, however you think of them as economic processes, that can lead you to a lot of work and to a lot of insights that you won't get from sociology or whatever. Finance didn't exist when I started. I mean, doing research in finance when I started was like shooting fish in a barrel. There was nothing there. So the whole area, all of the stuff that came out of the 60s and the 70s, starting with Markowitz in '53, which was a thesis at the University of Chicago, PhD thesis at the University of Chicago. All those ideas came across in a period of about 20, 25 years. And they basically formed the field of finance as it is today, ending with the options pricing model, basically. So those are all the big ideas that I've spent my life on. And all of the empirical work that went with it. Now, all of them didn't survive the empirical work, but it generated them, and we've learned. What Harry Roberts taught me about empirical work was, don't get hung up on a specific hypothesis. Your criterion should always be that you learn something from doing it. You learn something from the data. Forget about hypothesis testing. That's just a way to describe the data. But the way you judge the work is, did you actually learn something
Interesting.
from it?
Interesting.
That's been my motivation basically since then.
And so on that note, what have you learned out of all the things you've done? What have you learned in your work that was the most surprising or interesting?
Surprising or interesting? Surprising is difficult because the way I work is I start on an idea and it keeps growing on its own. So I've never been one who thought you start with a big idea and then you work on it. I don't think that works for most people. It never worked for me. So you start with an idea and you work on it, and it keeps growing on its own. You keep thinking about it. And you develop a sequence of papers on that idea. So all of the testing of asset pricing models, that started, my version of it started with the Fama-Macbeth thing, which is still being used to this day. That was a big technique thing. There's been other technique things. Now we're basically doing lots of empirical work, but we haven't had a really new big paradigm for a long time.
Okay, thank you. Now I'm going to ask you what you think of, and these should be very short answers, like one sentence, about different people in the world of economics.
Okay.
And just whatever comes to your head, one sentence kind of thought on the person.
Or no sentences, maybe.
Or no sentence. You can say one word. You could say, or a grimace.
Right.
Whatever. So Fisher Black.
Fisher Black was a great thinker. Fisher would have 1,000 ideas, 997 of them would be totally wrong, and the other three would be brilliant. Really, that's really. But that's not unique to me.
I know.
That's not unique to me. So I remember once he gave he had written a book or something, and he was giving a seminar at it at Chicago. And Bob Lucas, who's a pretty big guy in economics, sitting next to me, and we're listening to him. And Fisher had this way of doing a seminar where he'd talk, and then he'd stop. And he'd take out his book and start a little book and start writing notes. And he got done, and Bob and I looked at each other and said, "What in the world did he say?" So that wasn't one sentence, but
No, that was great. That was great. Yeah. If they're like this, they could go on. Myron Scholes.
Myron is a great, he was in the option pricing model, and he wrote a great PhD thesis, which was empirical at the time. So that option pricing stuff was a huge contribution. And then he went off to do a kind of, when he went to Stanford, he went off to do kind of accounting stuff. So he's been a huge star in the field. So I was his thesis chairman when he was a student. So I had a student get a Nobel Prize before I did.
Wow.
Which was great. Because I had been saying for years, if they have a Nobel Prize, it's got to go to the options pricing model. Otherwise, something's wrong here. And finally it did. But it's too bad Fisher didn't get it at the same time.
Paul Samuelson.
Paul was a giant in the field, obviously. And he was, I wrote a little paper in 1965, basically saying that all the stuff they had looked at, what happened was my dean sent me a computer, a first personal computer, because he thought I was a big computer user. And if I used the personal computer, the whole faculty would get into it. So he sent me one, and I did this little paper saying that the real rate of interest had been constant for like 25 years. So it was interest rates and inflation was the forget whether was it that way? I forget the exact name anyway. But I didn't realize, I wasn't into macro at that point. So I didn't realize that saying the real rate was constant was like anathema to these macro guys, because they always talked about this is what the Fed's controlling in order to control the economy. And I said it hasn't changed for 25 years. So I went to MIT to give the paper, and the whole faculty, there's a pretty good faculty there, right, at this time. And we went through the paper and everything, and they were doing the usual stuff people do. And then the next day, or at the same day, I guess in the afternoon, Samuelson and I took on two other guys in a doubles tennis match. And he said, I heard you're pretty good, so I'm just going to stand to the side and let you beat them. And I did.
That's great. Who were the other two?
I forget their names, actually.
So Franco Boligliani.
Franco was incredible. Franco was a guy, he came to Chicago for a summer when I was like in my second year on the faculty. And we did a finance summer, like a summer retreat. And we had people coming from all different places. And Franco, who was already a well-established star, he would spend an enormous amount of time helping people with their papers. I was really impressed. Now, Mert had done that with me, too. I mean, his co-author, and that's why he was there, was because Mert was there. But I was really impressed by that he would do something like that. And of course, he was, you can't say he wasn't a great star in economics on his own.
Steve Ross.
Steve and Bob Merton were the two smartest people I've ever known in my life. I mean, in terms of absolute quickness, just absolutely brilliant people. And Steve was so wide-ranging and so quick to pick up stuff and so quick to see through everything that it was amazing. It really killed me that he died so young.
Jack Traynor.
Jack, I did not know that well, but I really didn't know Jack. People say he invented the capital asset pricing model, but I don't know. I haven't seen the paper, so.
What about Bill Sharp? Speaking of capital.
Bill. The capital asset pricing model is a monument to creative thinking. I remember I was responsible for calling it the Sharp-Lintner model, and Bill called me and said, "That's good." He said, "As long as you put my name first, so people can guess the reason."
That's funny. So even though you put Lintner out there, and some people call it the Sharp-Lintner-Mawson,
right?
Why didn't those guys get the Nobel Prize? Or
They died.
Oh, they did die.
Yeah.
That was it.
Right.
They died before 90.
Well, all Mawson did was put equations on it.
Okay.
He didn't develop anything, but Lintner actually did the whole equation bit on his own, and it was published maybe 2 years after the Sharp model. Sharp was basically a geometric interpretation.
Yeah.
And Lintner had the equation version of it, so he had really done the whole thing on his own. You read that paper; it's a masterpiece, and it doesn't get much.
Wow, yeah.
So,
but you say he did die before 90.
Yeah, he died before.
And so, if of all those papers, you would say Lintner is the paper really every student should read.
No.
no. But I thought you said that.
I did say that, but I didn't mean you should read it because John was a great guy. He had a bad reputation at Chicago because he had done a criticism of Modigliani Miller.
Okay.
And Mert was kind of thin-skinned, so he was bad-mouthing Lintner all the time. And when I read this piece by Lintner, I said, there's something wrong here. This guy's actually pretty good. When I met him and talked with him and everything, he was really a lovable little guy. So it's too bad he didn't get as much credit. I think I was responsible for actually putting
Lintner in there
in the game. Yeah.
What about Harry Markowitz?
Harry was the beginning of finance. His thesis was, portfolio theory that Sharp developed into the asset pricing model. If you go back, the thesis itself ends up as a short paper. Then he wrote this book around it where he develops quadratic programming. A kid developing quadratic programming. And the whole book, utility theory, all of it developed in great detail long before people were doing this. And that's all. Then he stopped. Didn't do any more. He went into consulting. So Harry's a brilliant guy. If you ever talk to him, he's a brilliant guy.
Robert Schiller. Because you won the Nobel Prize with him. That's the only reason.
Right.
Robert Schiller.
Well, he made this point that stock returns are much more volatile than you can explain with dividends or even earnings. Well, earnings you can do a little better, but with dividends, which is a valid point. Now, that's a model that only works if you say the discount rate's a constant. The problem is, if you let the discount rate vary, then you really can't say anything. But the work did inspire lots of debate, discussion about, okay, how much variation do you need in expected returns to explain all this stuff. So it was a seminal paper, and he's done a lot of seminal work with John Campbell on time series kinds of stuff.
The other person that you won the Nobel Prize with, Lars Hansen.
Right. Lars is a genius, but remember, I'm a French major, right?
Yeah.
Lars is the opposite on the other side. He doesn't speak or understand French, but he understands mathematics very deeply. So most of his stuff, he did some great stuff on testing asset pricing models, but he's done a lot of other stuff too. But he's a guy I can admire without being necessarily able to read or understand everything he does.
I see. Okay. And then your co-author for many papers, Kenneth French.
Right. French is too much like me, unfortunately. So, I mean, he works incredibly hard, and he's incredibly good at handling data and interpreting it. What I say is, he does all the work, I take all the credit. That's how we split the work job.
That's funny. This is a question from a Nobel Prize winner
Okay.
that they submitted it to me.
Okay.
So this question is from Bill Sharp, and he asked the following question. Do you believe that someone saving for retirement today should hold a portfolio with more than market proportions of small stocks and value stocks?
There's no answer to that question. No, really, there isn't. It's a question of taste. You cannot say what any person should hold without knowing what their utility function looks like. So I don't know what the answer to that. Tell me what the utility function is, and we can figure it out.
Okay. Moving on to some other topics now. Academia as a whole. What has changed the most in the life of academia for an academic economist since you started in 1960? And what is better and what is worse?
All of the fields of economics have expanded dramatically in that period of time. So it's much harder to be a new guy coming across now. PhD students, I was 2.5 years when I finished mine. Most people went 3 or 4 years. 3 years was unusual. Now they're going 6 years routinely. And that's, I think, because it's so much harder. There's so much more stuff they have to absorb. It's difficult to come up with a workable topic. So that's an evolution that's taking place. So in finance, when I started, there were no good journals. The Journal of Finance was atrocious. And then Mike Jensen started the Journal of Financial Economics, and that competition raised the Journal of Finance up. So now there are 4 or 5, at least 6 good journals in finance. And lots of them are now monthly. Lots of the good journals, the JPE is now monthly. Lots of the good journals are now monthly. So the area has exploded. All of economics has exploded. So that's what's different about it, in my opinion.
Okay.
So you had, when I started, the only good finance departments were Chicago, MIT. You had trouble coming up with the third one.
Wow.
Now, everybody has a pretty good department. There are thousands of pretty good people, really good people.
Wow. Okay, let's move to questions about society. What do you think is wrong with society today, and what do you think is right with society today? These are the tough ones.
Yeah, I don't know. What's wrong is what we talked about in the beginning. I think people are expecting too much from their governments that the governments can't really deliver. What's right with it? A lot of things are right with it. I think life is a lot safer now than it was back when. If we'd had, this pandemic would have wiped out the world without the science that we have nowadays. So certainly, medicine's made tons of progress. I probably wouldn't be alive now if I were born 30 years before I was born. So I don't know if that's a good thing or a bad thing.
Here's kind of a funny question. If economists ran the government rather than lawyers, would we be better off?
If economists ran anything rather than the people doing it, we'd be worse off.
So you think it would be worse? It would be worse if the economists were
What, run the world or run the government?
run the government instead of the lawyers.
No, you don't want economists doing it.
Okay, so now we're
I'm
going.
not sure lawyers are good at it either, but
We're going to go to some more personal experiences and softer type of questions and things of that sort. So, what can you tell us of some funny story in your life that most people don't know about?
well, I told you how I got into Chicago. So
Yeah, we got that story.
I,
But that,
I burned that one already.
yeah, you burned that.
Yeah.
Any other?
Funny ones like that? Oh, yeah, I'll give you a good one.
Okay.
So, we lived in Europe for a couple of years, and I'm not sure this happened at that time or another time, but anyway, we went to a conference, my wife and I, we went to a conference in Bergamo. And before we went there, we went over to the Adriatic, and we got on a boat, and we went out to an island to have lunch. We said, well, when we were going out there, we said, this is a place where we were supposed to meet our friends, the Rolls, Dick Roll, one of my former students, afterward. And we said, oh boy, this is 150 miles out of the way. They'll never find us here. This is one place we can go that they won't show up. We sit down and are eating. We look out, and the boat's coming out, and there they are in the front of the boat. So,
That's fine. I assume they joined you.
Yeah.
Yeah. So you're originally from Italy, maybe way back. What's your favorite thing about Italy, or your favorite Italian thing?
my wife.
That's a good answer. Okay, another. You are Catholic, and what is one way that a Catholic upbringing has made an impact on your life?
Oh, poof. My parents were really. My father used to pass the box, in the church, and he'd put it in front of me, and he'd shake it like this, tell me to put some more in. But anyway, what has shaped my life? Well, they were very religious, but going to Catholic schools through the first 12 years of schooling was very important, although they were very prejudiced against Italians. When I went to high school, the brothers told me, forget about going to college. Become a tile setter like your brother-in-law because you're not smart enough. And then I went to Tufts, and I said, boy, this isn't that hard, you know? And all the Irish kids from my high school that went there were having enormous difficulties. And I said, there was something wrong back there. You know?
Wow, that's interesting.
But anyway, what I learned out of it was a discipline in studying that I got from the Catholic school system that basically dragged me through college and through graduate school. An ability to concentrate that's pretty good.
So if you had to do it again today, you would suggest, if you're Catholic, to send your
Well,
kids?
in my background, so of the charities that I support, lots of them are, I'm not that good a Catholic, but lots of them are Catholic schools because I think they serve the purpose that they served for me. They get poor kids and they give them pretty good education. And that's something that they're missing if they go to the public school system, unfortunately. It's just terrible for the country as a whole that the public school system's so failing in doing good things for poor people. So as much as possible, I try to get these kids into the Catholic school system or any private school system that they can get into. I'll help them along.
Speaking of your wife, which you mentioned earlier, you've been married, I think, 62 years,
Yeah.
something like that. And she was the woman you met in college.
No, high school.
High school.
Right.
High school. Wow. So has traditional family life made your life better, and how has it made it worse?
Worse, it doesn't make it worse, but I mean, if you put family life next to so you have your professional life here, and you have your family life, it's here, you know, it's not comparable. Almost so much of your personal satisfaction comes from your family life. I really feel badly for people who haven't experienced that. I mean, who haven't had, we had 4 kids. That was not easy to have 4 kids. starting from age 20. We had 4 kids when we were 24 years old. It was difficult, but it's been, in the end, very rewarding.
How did you manage to do so much research when you had little kids? You know, they take so much time.
She did all.
Yeah.
When I got the Nobel Prize, my youngest daughter, when they were interviewing people from the family, she said, you know, he couldn't have done all this if my wife hadn't let him do his work and she'd taken care of the kids and brought them to school, library, everything else. So it takes an enabler to make these things work.
Did your kids also go to Catholic school?
No, they didn't. They went to they went to the lab school at the University of Chicago. That's pretty good school.
How did your life change after winning the Nobel Prize, and what is the coolest thing that happened to you after winning the Nobel Prize?
Well, before I was Rodney Dangerfield before I got the Nobel Prize. You don't get any respect, right? When you get it, you get all kinds of respect. It's not clear you deserve as much as you get, but you get all kinds of respect. But before I got it, I said to myself, people had already said maybe we'll get it at some point. And I said, there's one thing I'm going to do, because I had seen people that I won't mention that I don't think it was healthy for them, because they gave up their work, and then they just kind of did a victory lap for the rest of their lives.
Yeah.
And I said, I'm not going to do that. I like what I do, and I'm going to keep doing it. And I'm going to turn down all these invitations to go here, there, and otherwhere to give talks. I'm just going to do. I've never done that. Gone to all places to give talks. So I said, I'm just going to keep doing what I've always done, because I've always enjoyed it. Why would I stop? And that's what I've done, basically.
That's since you won the Nobel.
Since I won the Nobel.
So, and you could have gone anywhere in the world. I'm sure you've been invited.
Every week you get, every other day you get an invitation.
Wow. Okay, now we're going to talk a little bit back about family. Who was a mentor of yours? Can you describe the greatest lessons he or she taught you? What are the greatest lessons that you have passed on to your students? So 2 questions.
Well, I think I mentioned this already. In my time at Chicago, it was Harry Robertson and Merton Miller who basically ushered me through the PhD thesis stage, which is where I learned everything. I mean, I didn't learn much before that. Actually going through classes you learn stuff, but you learn by doing, basically, if you're going to do research. So they were hugely instrumental in that. And what do I try to pass on to my students? Well, what I try to pass on to them is decide early on whether you really want to do this, in the sense of, are you motivated to do research without anybody pushing you? Because that's what's going to happen. Nobody's going to push you to do it. And if you're not a self-motivated person, and you don't really love to do it, find something else, because this is not for you. That's basically all. So it's through time, what's happened is PhD students need more cuddling than they used to need in the old days. And I don't think that's necessarily good for their development. If they have to be really pushed along that way or dragged along that way, they're probably not going to make it. Mm-hmm. So you really want the people that have enough self-motivation to carry it through. But who knows? I mean, everybody has their own model about that stuff, I think.
Okay, thank you. What is something that you have learned from a family member that has helped you in your life?
Oh, boy. Well, my mother took me to the library every week when I was a really little kid and would make me take a book. She didn't care what I read. So I read every sports book in the library when I was in grammar school. But she didn't care. But she always said, and my father always said, you can do all the sports you want as long as your grades are good. And they never came and watched me play sports. I was a legendary athlete when I was a kid. They never came to any games or anything because they said that's not important. You gotta go to school, and you're gonna go to college. Nobody in my family, 3 generations, had ever gone to college. They said, you're going to college. Now, they didn't say that to my sister, who was at least as smart as I was, but in those days, girls weren't expected to go to college, so
Right.
they didn't.
And what sport was it that you were so good at?
Baseball, I could have been a lousy minor league player. I had the highest batting average in the state. I hit 500. But they weren't looking because 250 of that was bunts. But we got to the semifinals 2 years in a row. This 500-kid Catholic school got to the semifinals of the state for 2 years in a row. Football, we won the state championship, Class B. Track, I came in second. Guess the event.
Long jump.
High jump.
High jump, yeah.
A Sicilian kid jumping 5'10"?
Yeah.
It was over my head.
Yeah. But your parents never came to any of those?
Never.
Those baseball
Nothing.
games? Nothing?
Nothing.
Wow,
I didn't care, actually.
yeah.
I mean, I knew that was the game.
Yeah. That's great. And did you even consider going to college for baseball or doing baseball in college?
I did, but then I kind of lost. It was way too serious in college. Football was way too serious. I remember I was on the freshman team in football, and I was first team, and we used to practice. We would do for the varsity, we would do the plays of the team they were going to play that week. So one week, I took the ball, ran it for a touchdown. And so the coach of the big team came over and said quietly, "Run that play again," to us. Ran it again. I ran for another touchdown. He came back the third time and he said it out loud, "Run that play again." And they killed me.
Yeah.
And I said, "Well, there's something wrong here." I'm disposable. So I kind of didn't take it seriously thereafter. I always did enough so that I wouldn't play. I mean, I always slacked off enough so that they wouldn't play me.
Okay, another question. Out of all your accomplishments, what are you most proud of and why?
I think I'm most proud of my kids, actually. But if you mean professional accomplishments?
Well, whatever you want, yeah.
Yeah, no, there's no, everything else is a distant second.
Okay. What 3 pieces of advice would you give to students at the University of San Francisco to be successful in their business career or in their life?
Oh, and your life is more important. So this is the advice I give to all the kids who ask me this. Find something you like to do, that you love to do, because you're going to spend a lot of time doing it. And the second part of that is try to find something that not too many other people are doing, because otherwise it won't pay very well. That's it.
Those
right,
two.
right.
Okay. Well, I think we are at the end, and I want to thank you very much for doing this interview, and
my
it's been an
pleasure.
honor. And thank you very much.